All right, let's dive into a really interesting one today, Lindsay Corporation. Now, this is a company that just dropped their latest earnings. And on the surface, well, it didn't look great. But then the market did something totally unexpected. So what in the world did Wall Street see that the rest of us might have missed? Let's get into it. Okay, so right off the bat, here's the puzzle. On one hand, they beat on earnings per share, but just barely, by a single penny. On the other hand, they missed on revenue, and not by a little bit. Usually, when you see a split decision like this, the market gets kind of nervous, right?
Well, not this time. The stock shot up almost 7%. So that's the big question we're going to tackle. How does a company miss its sales numbers by nearly $12 million and still see its stock soar? The answer, as you're about to see, is hiding deep in the details, way past the headlines.
So to figure this out, we have to unpack the numbers. And what we find is really a tale of two completely different businesses inside of one company. Investors had to pick a side, and they definitely did.
Okay, let's get into the nitty-gritty. Revenue clocked in at about $156 million. That's down 6% from last year, and it's a big miss compared to the $167 million Wall Street was looking for. Operating income also down 6%. I mean, look, if this was the only slide you saw, you'd be betting the stock went down, no question.
But here's where it gets interesting. You have to split the company in two, irrigation and infrastructure. And believe me, their results were like night and day.
And this chart just lays it all out plain and simple. Their huge irrigation business, down 9%. That's what tanked the overall revenue number. But look at this. The infrastructure side of the house was up a whopping 17%. That was the first big clue for investors that something good was happening under the hood.
Now, the slump in irrigation wasn't a complete surprise. Management laid it out pretty clearly. You've got farmers in the U.S. holding off on buying new gear, you've got higher interest rates making things tough for growers down in Brazil, and some big international projects just didn't land in this specific quarter. The key takeaway here is that these feel like temporary headwinds, not like the whole business is falling apart.
Okay, but that's all looking in the rearview mirror. On any earnings call, what investors really care about is what's coming next. And this is where the whole story just flips on its head.
So, the CEO, Randy Wood, gets on the call, and while he doesn't give specific dollar figure guidance, the words he uses are incredibly important. He's talking about a robust funnel and a multi-year runway for big projects. When a CEO talks like that, it's basically a massive vote of confidence. He's telling the market, don't worry about this one quarter, we've got big things lined up.
And then they dropped the bombshell. Right after the quarter ended, so it wasn't even in these numbers, they announced a massive new deal in the Middle East and North Africa. The price tag, around $80 million. Let me put that in perspective for you. That one single deal is worth more than half of all the revenue they made in this entire quarter. It's an absolute game changer.
Naturally, during the Q&A, analysts hammered them on the weak U.S. market, and management's response was super telling. They said the market is bouncing along the trough. Now, what does that mean? It means things aren't great, but they've probably hit rock bottom. It's not getting any worse. And for investors, hearing that the bleeding has stopped is a huge sigh of relief.
So let's put it all together. You've got a bad headline number, but you also have a booming infrastructure business, a U.S. market that's hit bottom, and a monster new contract waiting in the wings. So how did the market weigh all this? Let's walk through the logic.
This is basically the step-by-step thinking that sent the stock flying. Step 1, you look at the revenue miss and say, okay, got it, that's in the past. Step 2, you notice the strength in infrastructure and think, that's interesting. Step 3, the big one. You hear about that $80 million deal and you immediately start pricing that future revenue into the stock today. And that leads to step 4. You decide that the future growth from that one deal completely outweighs the temporary slump we just saw. Simple as that. The market voted for the future, not the past.
All right. So with all that in mind, where does the stock go from here? It's time for our final take and our official rating.
So here is the billion-dollar question, right? The stock already jumped 7%. Is the party over, or is there still room for it to run?
Here at Talk Tickers, we're giving this an outperform rating. We think the market got it right. Look, the entire story for Lindsay over the next year is going to be about one thing: delivering on that massive Middle East contract. Now, you might see some choppiness in the stock depending on exactly when they book that revenue, but the overall direction looks pretty solid. If they execute on that project, it should easily make up for any lingering weakness in their other segments.
And of course, we have to say it. This analysis is for informational purposes only and is not financial advice.